Okay, let's look at the schedules, which is the harder part for most taxpayers and for the tax preparers. And we're going to cover the major schedules, not all the schedules, but the major ones. This is, first of all, Schedule A, the itemized deductions. This is the one most people use, and major ones are covered on the following slides that make up this page. This page changes a little bit over the course of 20 years, but like the tax form itself, there's very few changes made, irrespective of what Congress does or the courts do in changing the law. It's just usually a line or something that's changed. For example, today in the medical, we also changed drastically in the last few years. Today, deductions only for those charges over 10% of AGI. Again, when I mentioned earlier about the AGI is where I spend my time on working, because the AGI, there's several things. First of all, it's a threshold for taxation, or deduction in this case. Second, anything that's an adjusted gross income is not going to be lost through thresholds and maximum incomes like we'll find for standard itemized deductions and exemptions. And finally, the AGI can be used for doing calculations of some of the tax advantage tax credits. So if you're eligible for tax credits, the AGI becomes a very important number. So AGI we'll find all over the place when we work on a tax return. Medical expenses of doctors, prescriptions, tests, hospitalization, home care, hospice, nursing care. Most cosmetic surgeries are not allowed. There are exceptions, obviously. There's exceptions to really any rule in taxes. I had a client who had severe burns on his face, and he had cosmetic surgery so that he looked more normal, there were less scars. That was covered. So to say all cosmetic surgery won't be covered. A lot of it's the way it's written up. Some plastic surgeons are very good writing up what they did and why they did it. And those doctors obviously do a lot of business, because one person tells another, hey, we went to Dr. So-and-so and he was able to make some changes that made it easier for me to get a tax deduction, saying how it was necessary for psychological purposes or whatever purposes you can think of. And travel expenses to a nominal amount are, and that includes if you have to go to therapy. For example, a friend of mine who lives here in Los Angeles had went to a cancer specialist in Phoenix. The travel there and back was covered. Again, no one's going to get rich on it, but it does cover part of the mileage cost. And finally, you could even include modifications of residence based on doctor's directions. For example, we had one where my clients were, the child had a problem with muscles, and they wanted to have a swimming pool. The doctor suggested a swimming pool put in so that the child could build up the muscles and etc. So the pool was paid for by the government. The key was we had to pay to the contractor direct. You don't pay to a third party, you pay to a contractor, and they'll cover it. Another person I knew, although I did not fill out his tax return, had one of these electronic seats that go up the stairwell put into his house because he could no longer walk. And again, it was covered by the IRS and as a deduction. And again, it's how the doctor writes it up becomes very important. And I would suggest many times when you're going to go to the doctor to have some changes to the house or yard or even cosmetic surgery, to maybe talk to a tax accountant first on the type of wording that's useful, and you can pass on to the doctor in case the doctor's not aware of it. Taxes, And we can take out either the state and local income taxes or the sales tax, whichever is greater. And so if you are in a state that only has sales tax, not an income tax, it's obvious what you take. And if you're in a state that has income tax but not a sales tax, if there is such a state, you that. But if you got both, you take it. Now, how can your sales tax be higher? Well, if you buy a new boat, you buy a new car, things like that, sales tax can add up and be much higher than the state income tax. Second area we get to take taxes off is real estate taxes for all property for the county tax bills. That's not special assessments or anything like that. It's your county tax bill that's issued usually in November and has November and April payments or December and April payments. And for every property you have in the United States, you can take that off. And next we have personal property taxes, which is basically auto boat for most states. There are states that have personal property taxes. Again, that is deductible. And then we have state disability insurance. If it is a state program, it is not deductible. It's the private programs that are deductible. And then we have assessment for street repairs, street lighting, etc., that are not deductible. So you have to really look at the items. Relatively few taxes will be deductible. And that usually somehow relates to real estate or expensive assets. The next one we have is interest. We have two residences or less. We can include the refinancing. There's caps of about $1.1 million approximately, and which you can take the interest. If you have more than two residences, you can only get the interest deduction on the first two. So if you take someone like Senator McCain, with I believe he has 5 houses, they are able to take it only on 2 of the houses, the deduction for interest. And again, there's a cap of the $1.1 million. And we can also take mortgage insurance and points in many cases. There again, you have to look at the instructions from the lender, see if it qualifies. And finally, there's investment interest. And investment interest is one that, again, usually that's the margin that counts. And finally, the main point probably is personal interest, such as credit card debt, is never deductible. So if you borrow money from Uncle Louie and you owe interest on it, you borrow money for anything other than education. Education is the exception. Again, that is covered under the adjustments to income and also tax credits. But other than education interest is not deductible for personal use. So I've had clients who bought a new refrigerator or bought a new car and they were paying interest on it, not deductible. They say, but it's a capital item. Well, yes, it is a capital item, but it's not deductible. And that some people pick that up early, easy, some don't. Our next one is gifts to charity. First of all, the charity must be IRS qualified, and that excludes about 90% of the charities out there. I know where I live, there's a CVS that for years allowed people to go in front and have their little pans or cups saying money for children or help orphans or help disabled, whatever. And none of them really charities. In fact, in many cases, the person who was collecting probably kept all the money. Who knows what happens to the money? It must be IRS qualified, which means you have to check it out. You have to go to the IRS website and verify, yes, indeed, it is an IRS qualified charity. Some charities you hear a lot of unqualified. And as a general rule, it must be an American charity. Now, the American charity can spend money overseas, but there are very few overseas charities that are qualified. Doctors Without Borders is one I can think of, and it requires Congress. For example, Congress a few years ago did it for Haiti under the Clinton administration for relief there, but it tends to be rare that it's an outside the country charity. It usually has to be an American charity, and the American charity can spend the money wherever they want to. For example, the Red Cross is a good example, or the Boy Scouts. It's limited yearly deductions, and yearly deductions have limits based on four things. First of all, the adjusted gross income limits how much you can give to charity, your private or public charity status, and private charities, a foundation really, where public charities are the ones you usually hear about who collect from the general public. The nature of the asset, is it a house or is it a computer or an ambulance, whatever. The use by the charity of the item, all of this affects how much the deduction is. I would say that the best deduction is always cash, and you can't go wrong with cash as a deduction as long as you got a receipt, and that becomes very important today. For many years, the government did not require receipts on charitable gifting. Today, as a practical matter, I tell my clients, even if you're giving $50, get a receipt so that you get in the process, because there are limits depending on the type of item as to when you have to have a receipt to get a deduction. You may need to have an appraisal. Appraisals are not part of the charitable gift. Appraisals are part of the 2% of income deductions we'll talk about later. The documentation, that can be just a letter from the charity, or it can be a thank you note from the charity. It doesn't require a lot. There should be a value on it for a case that when you give assets to the charity, like the Salvation Army, in our case, I get a little note that says blank receipt, and you fill out a receipt as to what you gave them and what the values are. Again, that is supposed to be done by the charity, but the charities tend to leave it to the donor to fill out. And I would say that for the most part, the charitable deductions for people give, which are the cars, etc., are worth a lot less than they expect. There is one case where I would say I do recommend giving something to charity other than cash, and that's when you have an asset that's appreciated drastically, and it's got to be an investment. So we'll just make it simple. We'll say I have Microsoft stock that I bought for $5 a share, and it's now worth $100 a share. If I cash that in, I'm going to pay a large tax, obviously, because it's a capital gain. But if I give it to charity and it's less than 30% of my adjusted gross income, I get to take the fair market value as a deduction, not my basis. So that can be a big advantage. And so when I have clients who want to make charitable gifting and they have a big asset or an asset that's appreciated drastically through a period of time, that becomes an excellent candidate for gifting. That, and again, the cash. Other than those two, I really don't advocate the other things. It's just too complicated, raises a lot of questions, and so often you want to put it, need to get an appraisal, and again, appraisals can be expensive. We had a situation in my house where we needed an appraisal for a problem we had. They charged us for each rug we had in the house, and each decoration we had in the house separately. So if you have 15 rugs in the house, and let's say it's even $50, that adds up very quickly. So again, have your clients stick with cash or those highly appreciated investments, if they have any. Casualty and theft loss. There's a lot of talk about this always, but it doesn't come to a lot of dollars. I've never had a case where an individual had a big claim because of rules, and I could say on my business clients, it was very rare that they actually got a nice tax deduction because of the requirements that have to be met. First of all, the IRS looks at the insurance industry as to what is a casualty. So if I can't find something, that's not a loss for casualty and theft purposes. If I have my trees rot over a period of time or termites over a period of time be damaged, that is qualify. So we have to make sure, first of all, that the transaction qualifies. And I mentioned here, theft is not, I forgot where it is, or I lost it. Or I had it when I left work, but when I got home I didn't have it, and I stopped at 2 grocery stores on the way. That's not a theft. There's different rules for personal and business property, as I mentioned. Personal property has a $100 per instance deductible, and the total of the losses have to be over 10% of AGI after taking account insurance. And again, that becomes pretty difficult unless you have things underinsured rather than overinsured. Businesses take into account impact of fair market value, depreciation, etc. on business things, which again means you have to have appraisals and you have to have a lot of activity with the tax department. I know there's some tax companies that are specialized in doing nothing but appraisals for damage to buildings, damage to businesses, and they are advisors to your tax preparer, and some of them are very good at what they do and find out ways for you to save a lot of money, especially if it's been a fire or a major theft. Again, proving it's theft, it becomes a big problem, because just because the inventory count is off, it's not a theft. Going back here, I would suggest that in case anytime you have what you think is a theft, you better have a police report. I found the police report filed with the income tax, if it's questioned, works magic. The problem goes away, irrespective of what the police report says. I had a situation with an older woman who lived in a condo, and she never left the condo except taking her dog for a walk, which was usually 10 minutes. And she also had an alarm system, and she claimed she lost some stuff, and she had a police report which she used, and the stuff added up to a theft, I'm going to say $500 or $700, which, because she was a lower income, that was a lot of money for her. And we were able to get the IRS to accept that because of the police report. Limitations on itemized deductions. If gross income exceeds the threshold, it is required to reduce the amount allowable for itemized deductions by 3% of the excess over the income threshold. In other words, there's a maximum number of itemized deductions you can take. For 2017, the threshold was $313,000 for a married family jointly, $287,000 for head of household, and $261,000 for singles. And when you hear about marriage penalties, which I keep telling my clients about, that you actually wind up paying more taxes by being married, this is a good example. If I'm 2 single persons could earn a total of over $500,000 and still get thresholds, but if they're married, it's reduced to $313,000. So it makes a big difference, married or not married. And I've encouraged people near the end of the year, we've crunched the numbers and delayed the marriage from, say, November or December to January. In fact, we've had people delay it from July to the following January because they were talking a substantial amount of money. And let's see, however, the reduction may not exceed more than 80% of allowable itemized deductions. In other words, you're always going to get some itemized deductions, and there's certain of the itemized deductions that you're not going to lose under the 80%, and that is the medical expenses, any investment interest income expenses, and casualty losses, or wagering losses to extent of wagering gains, which we'll talk about in a minute. But other than these 3 areas, all your deductions from your Schedule A are subject to being lost for the amount that's in excess of 3% over this income. So that's something that the computer automatically does for you. So in occasionally some client will say, well, I thought I had $400,000 with deductions. Yes. Now I got 80,000. Well, that's because of that issue. Likewise, a standard deduction versus itemized deduction. For those of you for 2017, our standard deduction $6,350 for a single. Married jointly, it's double that, which makes sense. And a head of household is $9,350. Now, what's it take to be a head of household? You have to have at least one dependent. Typical situation is it's a divorced person or a person never married who has a child, and that makes him the head of household or her head of household and gives them a little bit better tax treatment. Next is limitations on personal exemptions. Our personal exemptions for 2017 is $4,000. If the taxpayer's adjusted gross income exceeds one of the following amounts, deduction for exemptions reduced by 2% for every $2,500 or fraction thereof, for which the gross income exceeds the threshold amount. Very simply, Congress made a very complicated method of doing this. They have a tendency to do that, and I have no understanding why they do it. They never write it up, but again, you take the amount that's, let's say you're married filing jointly at $313,800, and let's say you're $100,000 over it. You divide the $100,000 by $2,500, which makes it 40, and you multiply it by the 2%, and there says the amount you're going to lose, which means that people with large families and have good incomes tend to lose the exemptions.